On to this now. South Africa's import bill could increase significantly to over 100 billion rand this year. And that's mainly due to a weaker rand, which has wreaked havoc over the last few days. But it's not just the concerns around South Africa's relationship with Russia. The rand has also been severely impacted by the constant power cuts. The recent weakness is likely to have an impact on the Monetary Policy Committee's interest rate decision that comes in next week. Professor Adrian Saville, Genera Capital investment specialist and professor in economics, finance and strategy at Gibbs, joins us this evening for this discussion. Thank you very much for your time this evening, Adrian. Let's start with that very notion, import bill for South Africa increasing to over 100 billion rand this year. For the layman watching this evening, what exactly does this mean?
I think it's important to emphasize that the number that you're referring to is an estimate that I made, and to be absolutely frank and clear, it was a back of the envelope estimate. Figuring out these numbers with exactness is tricky. But if we go on the assumption that the rand, or on the reality that the rand moved from 1820 to 1920 to the dollar against the over the course of the last week, and that the bulk of our imports are dollar priced, if the rand remains in this early 19 territory, then it would mean that if we continue to import the same things, it will cost us another 100 odd billion over the next 12 months. And that's a reasonable assumption because a lot of what we import is, to use the economic language, price inelastic, meaning we're relatively insensitive to price because we need these things. And the things that we are importing are food, fuels, and inputs into a manufacturing process, which means we essentially are obliged to take the price that is presented to us. Now, where this starts to translate into your and my circumstance is those imports very quickly move from the harbour wall into our houses, and the lag between the dollar move or the rand move against the dollar or any other currency and the price on the shelf tends to be in the region of about 6 to 9 months. And if we use that move in the rand against major currencies over the course of the last week or so, it'll add about 1.8% to inflation, working on those calculations.
Yeah, and I mean a very bleak outlook for the average consumer. Adrian, you also tweeted that there is a direct correlation between the power cuts as well as the weakness in the rand. Very interestingly, you actually called it the HDH model, if you will, hope, despair, and then hope again. And we're sitting in a space of despair at the moment. And perhaps break down that direct correlation and the implications it will have for things like interest rates, which are set to be announced next week. We were hoping that the Reserve Bank would start to taper down somewhat, as with global central banks, but this may not be the case for South Africa.
I'm chuckling not because it's funny, but because you grabbed onto my my dad joke about the hope, despair, hope naming convention for the model. But I think that captures quite seriously exactly what's going on in South Africa's economic circumstance, that no sooner have we been thrown some type of relief or lifeline than our economic structure and circumstance whips that lifeline away. And by way of example, commodity prices are a really good illustrator of that, where we were thrown a windfall and a wonderful economic tailwind when commodity prices ran very hard out of COVID-19 and quickly sat up. And that translated into substantial revenue windfalls for South Africa's commodity producers and exporters. The great, however, as you suggest, is that those efforts have been compromised by energy insecurity. And each escalation or elevation in energy insecurity corresponds with the rand weakening a little further. And so there's sort of one step forwards, one step or perhaps 2 steps backwards is what's going on in terms of the energy impact on the economy. If we add these two components together, the two parts of this discussion together, on the one hand, you've got inflation now that is looking increasingly baked into the system that's coming down the line at us, and at the same time, an almost racing certainty that the South African economy will finish the year smaller than it started the year. And in the language of economics, this is what we call stagflation, economic stagnation with inflation. And the perverse outcome in that circumstance is that when the Monetary Policy Committee meets next week, because of the elevated inflation, they are almost obliged to hike interest rates. A week ago, the suggestion was they would hike by another 0.25%. I'm actually inclined to suggest that we could see as much as another 0.5% because of the way the rand has moved. And that rand move must also be interpreted against the backdrop of what other central banks are doing, the European Central Bank, the Bank of England, and the Fed, where they continue to hike.
Yeah, I mean, there is an argument, as we conclude our discussion, Adrian, by some economists and analysts that the pressure that is put on consumers by the Monetary Policy Committee to preserve the value of the rand and to bring down inflation is too much. And so why can't the target band be moved upwards, given that the circumstances around load shedding, for example, don't seem to be changing, or they won't be ending anytime soon? In fact, the SARB saying that load shedding contributed 0.5% to inflation in the previous print when they gave us the last MPC monetary policy decision. What would you say to that argument?
I'll have to manage myself very carefully here to try and give a short answer, but 2 points briefly. The first is the role of the Monetary Policy Committee is not to look after the real economy, but to rather manage and care for the rand, our purchasing power, and that means inflation and exchange rates. The way that the rand has moved recently has got almost nothing to do with the South African Reserve Bank and everything to do with the politics and real economics of South Africa. And that then goes to a second point, which is what might happen if the Reserve Bank loosens its discipline in looking after inflation. South Africa has an impeccable record since Tito Mboweni ushered in the 3 to 6% inflation target of getting inflation, broadly speaking, and containing it inside of that 3 to 6% band. Why that is so important is it gives confidence to investors. It gives a scope of or an emphasis of certainty. And arguably even more important than investor confidence, it gives consumer stability and confidence, recognizing that the most vulnerable part of society is low and no income earners, and inflation hits them hardest.
No, absolutely. Thank you very much for your time this evening, Professor Adrian Saville, Genera Capital Investment Specialist and a Professor in Economics, Finance and Strategy at Gibbs.